So Chapter 11 is property dispositions. And basically what that means is we're disposing of the property, whether we're selling it, salvaging it, or trading it in. Regardless, we no longer own that, and so we have to look at the tax implications of that. And I'm looking at one of the problems in the back of the book. We've got a delivery truck that they bought for $30,000. And it was not subject to luxury auto depreciation, 2 years. And they've used Makers 200% declining balance. So we've got Makers 200 and the half-year convention. They've used that to recover the cost. So in other words, that's the depreciation method they've used. They did not elect Section 179 expenses and opted out of bonus. And it asks us to answer the questions for the following alternative scenarios. So assuming that they used the truck until it sold in March of year 3. So if it's sold in March of year 3, what depreciation expense can it claim on the truck for years 1 through 3? And so this is just a simple, using your Makers tables. We have year 1, year 2, and year 3. And our basis in every year is $30,000. And then we have our rates. And so it's a 5-year, let's go back to Chapter 10. The appendix in Chapter 10 gives you your half-year convention Makers. So it would be 20%, 32%, 20%, 32%, and then 19.2, but we sold it during that year, so we have to change that number. But those are our rates from the table that we use. And so in year 1, it would be $6,000. In year 2, $9,600. And then in year 3, because we sold it in March, the depreciation rate would be reduced by 50%. And that's how we handle that. And then of course, we have to use that for depreciation recapture and to calculate our gain or loss. So the depreciation that was taken would be $18,480. So it then says, assuming that they claimed $18,500 of depreciation expense on the truck before they sold it in year 3. So if instead the depreciation is $18,500, which is basically this rounded up, what is the amount of character or the gain or loss if they sold the truck in year 3 for $17,000 and incurred $2,000 of selling expenses on the sale? So we've got a sales price of $17,000 and we have selling expenses of $2,000. So what we look at is what gain or loss do they have and what is the character of that? And the way that we have to do this is we take the amount realized, and I'm kind of doing this the hard way just so you can see all the numbers, but the amount realized would be $15,000, which is the 17 minus 2. The original basis is $30,000. Accumulated depreciation is $18,500, which makes what we call the adjusted basis is the $30,000 minus the $18,500. So that's the adjusted basis on our books, or $11,500. And so the gain or loss is going to be the amount realized minus the basis. So we have a gain of $3,500. And then what we have to do is look at the Section 1245 depreciation recapture rules. And rather than do the little section squiggly, I'm just going to write out the word section. And the Section 1245 recapture is basically going to be the entire $3,500. And so this will be a gain recognized as ordinary income because it's Section 1245. Then it asks us what would happen instead if they sold it for $35,000 and incurred $3,000 of selling expenses. So I'm going to copy this, and I'm going to change this to, what did we say, 35 minus 3, so 32. And so now we have a gain of $20,500. So let me get rid of that because we don't know what that is yet. So we have a $20,500 gain. Now the Section 1245 is going to be the lesser of the accumulated depreciation or the gain or loss. So the lesser of the two is the accumulated depreciation. And then the remaining part of that will be $2,000, which will be a Section 1231 gain, which has different tax characteristics. So again, it's very simple. Don't let the terminology section this and section that throw you off. These are very common codes that we use in the world of tax. And there's a good chart on page 1117 that will help you walk through these. They're very straightforward and easy to understand. So if you have any questions, please let me know.